Do predictions work when it comes to timing the market or messing with the market in general? Let's talk about it this week here on the podcast as the guys are going to give us their predictions and dive into if these things hold any weight at all. Let's get it rolling. What's going on, everybody? Welcome into the podcast. Thanks for hanging out with Matt and Steve and myself as we talk investing, finance, and retirement. And guys, welcome to the new year, man. You know,
Happy New Year.
Yeah, you're right. Can we say that on the 8th? Today's the 8th. Can we still say it?
It's new enough.
New enough? All right.
New year, hopefully the same returns, right?
Hey, what was it, 20+% last 2 years? Pretty good.
Yeah. Hopefully we have a third.
Yeah.
What was the last time we had 3 years of 20+% returns? 90s?
The 90s.
Yeah.
I think right at 2000, and then we had the lost decade, so let's not jinx it too much, right? I think it was 98, 99, 2000, if I'm not mistaken. So
a little tech bubble, and now we've got AI coming. So there's a lot of predictions that people are going to be hearing. So we just wanted to run through
all these rock solid predictions that we're seeing, right?
All right. Well, hit us, break it down. Tell us how accurate these things are. What's the deal?
Yeah, the first one that we love hearing is when someone says there's a 35% chance of this happening or a 55% chance of this happening. So this slide here shows JP Morgan saying, hey, last year there was a 35% chance of a recession, but now we're increasing it to 45% chance. So what does that even mean? That means if there's a recession, they're right. And if there's no recession, they're right.
Yeah, I love these BS projections. I mean, we see them all the time at the beginning of the year. I kind of call this this stuff's like the People magazine of the finance world, you know? Read it for entertainment purposes,
Nice.
But the problem is a lot of investors, they read this stuff and they're kind of hands off. And it's like, well, I'm just going to go into my 401k, JP Morgan saying this, and I'm going to up my fixed income exposure. And if you did that last year, your portfolio didn't do a whole heck of a lot because they were very wrong, or I guess right, because they did say 35% chance of a recession, 65% chance of the market doing okay. But
Yeah.
I mean, you get, again, this is just entertainment type stuff because a lot of these predictions are just so far off.
Yeah,
Very
and
true.
we'll come back and pick on JP Morgan in a
We
little
like
bit.
JP Morgan. Don't get us wrong.
It's like weather forecasting, right? They say 35% chance of rain. If it happens, it happens. If it doesn't, it doesn't, right? You know, so either way, they're like, well, it was a small chance.
Yeah, and the problem people don't realize is the S&P averages around 10% in any given year. So you would expect that the return would fall into 8 to 12% every now and then. Maybe sometimes more, maybe sometimes a little bit less. But this chart here from DFA is really eye-opening because it shows you the gray area right there is 8 to 12%. That buffer range going back about a century. We've only fallen in that 8 to 7 range or 8 to 12 range 7 times in the last century. That's absolutely wild. So you average 10%, but it is a roller coaster to get there.
Yeah, wow.
This is a great chart too for just an endorsement on buy and hold. Yeah. I mean, you look at the good years, they far outweigh the bad years. And a lot of our clients, a lot of the boomer investors have it right. They're buy and hold investors. It's like, let's make sure income's taken care of. We do it in a safe way. And then outside of that, we want to own the market. We can take some risk because we know if we have that, 10, 15 year time horizon on a portion of the money, market's going to do well. I mean, we're going to have some bad years in there, but the good years will far outweigh the bad years. It's a lot of these younger investors that read these predictions and then try to market time. I had a good friend of mine who's a CPA. He's 40 years old. He called me and he goes, I read JP Morgan's prediction. It's up to 45% chance of recession this year. That's why we threw the slide in. He goes, I'm going to move 60% of my 401k into fixed income. And it's like, don't you dare, man. What are you thinking? You've got 20 plus years until retirement. So I showed him this chart. It's like, just own the market, own equities. You're going to be fine. And these predictions, in a lot of cases, are just complete BS.
Yeah, for sure. But I mean, those dots at the bottom there do happen. So that's where
absolutely.
You don't want to get caught off guard. So
that's why I did say make sure income is taken care of. If you are a retiree, know that you have a plan in place. But beyond that, longer term, I mean, it's nearly impossible to predict. I mean, we're going over these projections today, what the market's going to do on a year-to-year basis. But if you give us 5 years or 10 years, you have a pretty good idea of what the market's going to average.
Matt, go back to that one for just a quick second. Interesting. The furthest one down, you brought that up. You got 1929. You can see that one over there at the 40%. You got obviously something right around World War II, just slightly after that. And then the next one that's that far down is the housing bubble, right? 2007, 2008. So there's some other ones. Don't get me wrong. There's other ones, but like the 30 plus, only 3 times in what, 80 years, 90 years? So not terrible.
Right. It's funny. I mean, you look at some of these predictions too, and we kind of go back. We were talking about 2020, and it's like we're rolling from 2019 into 2020. All the experts are going, it's going to be a good year. Economy's on fire, market's on fire. We're just going to continue this. We're going to go right into a great year in 2020. 3 months in, it's like, move to cash. Oh my gosh, the world's on fire. We have this pandemic. And it's like, oh, hold on, wait, we're going to print ourselves out of this. Go move back into equities. So it's like from bullish to bearish to bullish. It just gives you an idea that nobody can predict what's going to happen in the short term. And something like that could happen again this year, and we could see a correction.
Yep. So statistically speaking, the market goes up 75% of the time each year. So 3 out of 4 years, you'll see a positive market. So generally, the predictions are going to be that you're going to see some sort of market growth, usually in that 2 to 10% range. So if we rewind to January 2024, we laid out all the various predictions from all these different companies. So all the way from JP Morgan at the left at 4,200 to Yardini Research at 5,400. They were the most bullish. JP Morgan was calling for actually an over 10% correction. That red line in the middle, that's where the average target was. And that green line all the way on the right, that's where the S&P actually ended up. So it was way past any of those predictors out there.
And it was over 6,000 until the Fed opened its mouth, and then it dropped a little bit, right?
Yep.
You're just really picking on poor JP today, huh? Yeah, I'd say we were on the right side of this red line. I mean, I understand, why some of the outlook was bearish. Go back to Q1 of last year. I mean, we were dealing with geopolitical risks, inflation concerns. What was the Fed going to do? How sticky was inflation going to be? Were we going to get good data sets? So I understand some of these predictions, but we felt going into the second half of the year we were going to see some rate cuts. We certainly saw those. The market did pretty well, but we weren't predicting 6,000 here.
No. I mean, we were very bullish that the AI train was going to keep rolling, and it did. So NVIDIA was 22% of the S&P return, the Mag 7 even more. So that was just a really hard year to predict. Is the Mag 7 really carried it? You never know when that train's going to stop rolling.
Yeah, tough year to predict. That's why I'm assuming that this is just kind of like a 1 year anomaly, 1 year thing where it's like they got it all wrong. But, going back 5 years, they're probably spot on, right?
Yeah. Funny you say that. Absolutely not. Predictions
look
are. At that. So I'm going to walk through this chart. So the red dot is the lowest projection on that list. The green dot is the highest projection on that list. Not one time in the last 5 years has the S&P fallen between the highest and lowest projection. So what does that mean? That means you can throw all of those predictors out the window. Do not pay any attention to it whatsoever. It means absolutely nothing. Going back to the COVID year, 2020, the blue dot is higher than the projection. The following year, the blue dot is higher than the highest projection. 2022, the opposite, the lower than the projection, and then higher the last 2 years.
Crazy.
It's just incredible that the consistency of this and how far off all these predictions were.
The consistency of inaccuracy.
Yeah.
And the fact that people still want to pay attention and want predictions from people. It's like this.
Well,
is
they got to stay
garbage.
on the air 24/7.
I mean, you could at least say we're going to be above the high end or below the low end. I mean, just go off of that. You just got to pick one of the two. Go 50.
Wow.
It's 50-50.
Yep. So breaking the numbers down even further. So this just charts it out where the average prediction was and where the actual return ended up. So we haven't even been close. We haven't even been within 10% with any of those 5 years.
I mean, if you're in the car right now, you go back to 2020, we're off by 13%, 2021, 19.2, 2022, 23%, 2023, 18, 2024, 22. So that's shocking.
Yeah, that negative year, obviously a lot of inflation on that 22 there, but yeah, massive, right?
Yeah,
so
entertainment purposes.
Yeah, 4.2 was the average, and it ends up, negative 19. So yeah.
Mm-hmm.
Yeah. So our whole point of showing you these slides and talking through this is just to let you know predictions mean absolutely nothing. Do not pay attention to them whatsoever.
But I said you guys were going to make predictions at the start of the show. You guys going to make me a fibber?
Segueing into our 2025 prediction.
Okay.
Yeah, these are our predictions. Yeah.
Well, sweet.
So I am the resident bull here. I'm going to maintain that we might see another double-digit year in the market. I think the Mag 7 will probably continue leading the way. But I do think we're going to see more broadening of the rally. Some other asset classes pick up as well. And I'm going to say that S&P ends near 7,000, maybe even breaches 7,000. So that'd be close to another 20% return. So I'm going to be the resident bull, take one for the team. And I'm also going to say that S&P could just as easily be negative. So don't go over allocating to equities based on.
Don't hedge here. Come on now. Yeah, I'm not quite as bullish as Matt here. I'm still concerned about the looming inflation concerns, the geopolitical risk, and then this tariff policy. I don't care if you're a conservative or you're a liberal. There's some uncertainty here. No one knows how this is gonna play out. So I want to see how that plays out. And with that uncertainty, markets don't like uncertainty. So I think we could see some volatility up front here on Q1, maybe in early Q2. But I do think we finish positive on the year. I'm not with Matt on his 20% year in a row.
I would agree with you that it's going to be a rough first half as we kind of roll out whatever these tariffs are going to.
Doesn't it have to be? I mean, we're going to have plenty to talk about because obviously once the administration takes over on the 20th, I mean, we're probably going to see some stuff fast and furious, which is going to, cause some ripples for the first quarter for sure. I was just looking up that 2025 earnings growth outlook analysts, by the way, predict that the S&P will finish between 8 and 10%, Matt, to your point for 2025, which you said is basically the average anyway, right? So they're not really swinging for any fences by
barely right. So that's why I'm swinging for the fence. I'm going for one here.
Gotcha. Okay. Yeah. So there could be a lot to talk about in coming weeks.
So moving forward, Steve and I are going to throw out 3 additional predictions here. So mine is going to be the Fed cuts more than 2 times. So right now, it is priced in at about 10% that the Fed cuts more than 2 times. 90% that they cut 2 times or less. Could even be a rate hike. Who knows? So I'm going to say they do cut more. Rewind back to January 2024. They were anticipating 6 rate cuts. We said we don't believe that. We think it's going to be less. It ended up being less. So it's kind of one of those, don't believe what they're saying, believe what you actually think is going to happen. So I think they're going to cut more than 2 times. And I think that's going to restore bonds and allow bonds to act like bonds.
I'm with you, especially after that last Fed meeting, that hawkish stance that they took. I'm thinking maybe 3 or 4 times. I don't know.
And again, that's probably, if you were to put odds on these, it's a 90% that prediction is going to be wrong according to the market right now. So that's kind of a bold prediction.
I think we could see a pause, and I think second half bonds act like bonds again. I do agree with you there. I kind of had to fight. I wanted that prediction.
Well, hey, they're down 0.5% to start the year here. So we'll see. So bonds acting like bonds again. I'm saying, hey, 4 to 6% return there. So outpace inflation, give you a little extra return. And then I'm going to throw that one in that NVIDIA continues to lead the Magnificent 7. I don't know how bold that is. I think that's a safe bet, but you never know.
Is that a layup?
It depends. I mean, we could easily see a correction in NVIDIA if Microsoft and Meta and all them stop buying as many GPUs, but that's just not stopping anytime soon. So I think that's a good bet right there. That's probably my easiest layup of the 3 here.
So my predictions here, I think the S&P is going to have a 10% drawdown. So I've said that to a few clients. It does not mean I think we're going to have a down year. I think we're going to have a positive year, but I do think we're going to see a 10% pullback at some point this year. A lot of people don't realize we saw an 8% pullback in 2024. So it's common, and we see it every couple of years. So I do think we will see something like that, and I think we'll see it earlier this year. Now, I could be wrong. Trump could get in. Tariff policy could go well. Inflation data, we could get some great data sets. Geopolitical concerns could go away, and and the market just rips. I could be wrong here, but I think we're going to see some chop up front, some volatility. I think we'll see a 10% drawdown. Value versus growth here. We've just seen growth has just done so well over the last few years. It's outperformed value. You look at the valuations on growth; they're getting pretty high. I just think it's value's turn to shine here, and I think it's not like I don't think we're gonna see 30-35% in value, but I think it could outperform growth by a few percent. And then we got this last one. I'm reading it and going, what the heck was I thinking? Matt smiling at me. Emerging markets or small caps outperform the S&P 500. I don't even know if I believe that.
What's your wild card? It's your wild card.
Yeah, that is definitely my wild card. I think there's some growth opportunity there in small cap. I think I want to see what Trump does when he gets in, but I think his policies will be beneficial for small cap. They could do well. Again, valuations. I feel like there's much more growth potential in small cap than there is with large right now. But that's not saying switch the allocations and throw 40% of your portfolio in small cap. It's bumped the allocation to small cap up slightly. And then with emerging markets, I mean, my gosh, it's underperformed for how long at this point? Over a decade.
They're due. And the last time you said someone's due, that was when the Tigers were in the playoffs this year. Spencer Torkelson was striking out every at bat, and you told me he's gonna hit a home run here. He's due. He's been striking out, and he ripped a double down the left field side, left line. And
okay, so so what Matt's saying is for you baseball fans out there, emerging markets is like a 200 hitter. Once in a while, they get lucky and hit a dinger. So,
but what you want. But the thing here is when they get hot, and that's just a momentum play. And at some point, emerging markets are going to start outperforming again. And right now, they are literally 3 standard deviations away from their historical average versus the S&P 500 and the valuation there. So it's not something you want to ignore. And the thing we're hearing from clients right now is being all in the S&P 500, they're starting to want to ignore bonds. They're saying, I don't want to own bonds. They've done nothing for 5 years. Or emerging markets. Small caps had a decent run last year, but let's just own the S&P 500, which is becoming increasingly dependent on these Mag 7 stocks, coming up on like 40% of the S&P 500 index. And that just carries so much additional risk. Not that I think the Mag 7 is going to have a bad year. You see that I think NVIDIA is going to have a great year, but there is a lot of uncertainty and hidden risk there.
There's more growth potential with small cap too, looking at valuations. I mean, I do think at some point they will outperform. But again, that's just saying up the allocation maybe a few percent there. Certainly don't want to go 25-30% into small cap, especially with a new administration. We'll see what the policy change looks like in the future.
Yeah. So really what we're preaching here is just stay diversified, and also revisit your goals. So a lot of people when we built these plans 3, 4, 5, 6 years ago, we were off the assumption of, hey, maybe we earn 3 to 6%, and we've more than likely outperformed it. So you might be able to take some risk off the table at this point. So reassess your risk profile and make sure that the equities haven't creeped up like we know it has for a lot of investors out there.
Yeah, make sure you go in and trim your gains too, because I mean, as you build up your portfolio in retirement, and I was just talking to someone who had a $2 million portfolio, and we were talking about a possible 20% pullback. What if we saw something like that? And well, that's a $400,000 loss. He's like, well, that's worse than 2008 for me in terms of dollar amount. It's like, yeah, not percentage, but dollar amount. Are you ready to lose something like that? So we went in and we trimmed some of the gains and just put them in safer positions. You can still go after some growth, take on some risk, but you want to make sure that you're going in, you're rebalancing, and you're trimming gains every year.
And ignore the predictors out there, because I'll end it with saying I know my S&P price target was bullish 7,000. I'm about 45% sure on that one.
So there you go. All right. So I guess that's the takeaway then, guys. So, the final thing is have a strategy, right? Have a plan, right? Instead of just kind of listening to the prognosticators.
Yeah, the good years are so much easier than the bad years, but just remember those. I mean, remember 2008 and what that felt like, because we will eventually have another year like that. So know your plan, know how you're going to move through a period like that. Or, I mean, talking about 2008, even the early 2000s, we could have 2-3 bad years in a row. Know how you're going to move through a period like that, because those are the difficult years. The green ones, those are easy years. Those down years, those can be tough. So as long as you know how you're going to move through a period like that, you can go risk on with any money outside of that.
Yeah, to that point. So it was 2000 the last time we had those backup runs, and then we had the .com bubble burst and stuff like that. And think about this, that was 25 years ago. Y2K, 25 years ago. So for anybody old enough to remember it, what happened? Nothing, right? No planes fell out of the sky that I know of. So, but either way, you got to make sure that you're having yourself set. So if you guys need some help, as always, you should know what to do by now. But if not, check the show note links below. I had to click that, so I had to make sure I had the right thing up. But make sure you check the show notes for links to get in touch with the guys. You can find them at retirementapproved.com. That's retirementapproved.com. Don't forget to subscribe to the podcast on whatever platform app you like using, Apple or Spotify for audio form, or of course YouTube in video form. Leave a comment, thumbs up, heart, all that good kind of stuff, so you can catch new notifications as they come out. And we'll see you next time here on Retirement Approved with Matt and Steve Paul from R.W. Paul and Associates. We'll catch you next time.
Retirement Approved is brought to you by Richard W. Paul and Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.